Between 1928 and 1933, the American economy followed a precise five-stage pattern that ended with the government seizing every ounce of private gold from its own citizens. Easy money flooded the system. Asset bubbles exploded. Then came the crash of '29. Banks failed by the thousands. And finally, Executive Order 6102 forced Americans to surrender their gold at $20.67 per ounce, while the government immediately revalued it to $35. An instant 50% profit for the state, a devastating loss for savers. For 41 years after 1933, owning gold was a federal crime. And here's what should terrify you. From 2020 to 2025, we have already completed the first 4 stages of that exact same sequence. The COVID money printing, the inflation surge, the aggressive rate hikes, the banking stress building right now. The final stage isn't a possibility anymore. Based on this pattern, it's inevitable. If you want to understand what comes next and how to prepare before stage 5 hits, subscribe, because they won't warn you when the reset begins. What transpired in America between 1928 and 1933 represents one of the most sophisticated wealth transfer operations in modern financial history. Yet conventional economic textbooks present it as a series of unfortunate coincidences, culminating in necessary government intervention. The reality reveals a far more calculated sequence of events that followed a precise 5-stage pattern, with the wholesale confiscation of private gold serving not as desperate crisis management, but as the predetermined climax of a carefully orchestrated monetary reset. This pattern was neither accidental nor inevitable, but rather the methodical execution of a structural transformation that would fundamentally redefine the relationship between citizens, currency, and state power for generations to come. The late 1920s witnessed an unprecedented expansion of credit and speculative activity that created the illusion of permanent prosperity while constructing the very foundations of systemic vulnerability. Banks loosened lending standards dramatically. Margin buying in stocks became commonplace among ordinary citizens, and the Federal Reserve maintained monetary policies that actively encouraged the expansion of money and credit to feed rapidly inflating asset bubbles in both real estate and equities. This period of easy money represented the first stage of what would become a predictable cycle of boom, manipulation, and ultimate confiscation. The speculative frenzy built on expectation rather than fundamental economic strength, creating excessive leverage throughout the financial system and establishing debt structures so fragile that any disruption would trigger cascading failures. As asset prices soared beyond any reasonable connection to underlying productive capacity, the second stage emerged through rampant inflation that extended far beyond consumer goods to encompass stocks, real estate, and commodities. The wealth effect from inflated asset valuations encouraged further borrowing against depreciated assets, creating a self-reinforcing cycle that divorced market prices from economic reality. This disconnection between speculative valuations and actual productive growth built up unbacked claims throughout the system, while concentrating wealth among those positioned to benefit from asset appreciation, leaving wage earners and savers increasingly vulnerable to the inevitable correction. The third stage arrived when monetary authorities, fully aware of the overheating they had deliberately created, moved to tighten credit conditions through interest rate increases and liquidity constraints. This classic deflationary countershock made servicing the accumulated debt burdens increasingly expensive, triggering margin calls that devastated heavily leveraged players and contracting credit availability across the entire economy. The resulting debt deflation cycle saw asset prices collapse while debt obligations remained fixed, creating a wave of bankruptcies that spread from individual speculators to businesses and ultimately to the banking institutions that had enabled the entire sequence. The fourth stage manifested as systematic banking failures and the complete collapse of public confidence in financial institutions. Bank runs accelerated as depositors rushed to withdraw funds from institutions that could no longer meet their obligations, while solvent banks froze operations and interbank lending ceased entirely. The credit crunch prevented new lending, while existing debt could not be rolled over, creating massive economic contraction and severe deflationary pressure that destroyed savings and eliminated access to capital for productive enterprises. This manufactured crisis created the perfect conditions for the fifth and final stage. The ultimate phase involved the physical confiscation of gold through Executive Order 6102, which criminalized private possession of monetary gold and forced citizens to surrender their holdings at artificially suppressed prices. This was not emergency crisis management, but the logical culmination of a process designed to transfer control of the monetary base from private hands to state authority, permanently altering the structure of American money and eliminating the traditional hedge against currency debasement that gold had provided for centuries. The first stage of the Great Monetary Manipulation began in earnest during 1924, when the Federal Reserve deliberately initiated a policy of abundant credit expansion that would fundamentally transform the American financial landscape over the subsequent 4 years. This period of easy money represented far more than simple monetary accommodation. It constituted the systematic construction of a speculative infrastructure designed to channel wealth upward while creating the illusion of broad-based prosperity. The central banking establishment, working in coordination with major financial institutions, loosened lending standards to unprecedented levels and actively encouraged margin buying in stocks among ordinary citizens who had never before participated in speculative markets. This democratization of speculation served the dual purpose of inflating asset bubbles while distributing risk away from the financial elite and onto the general population. The mechanics of this credit expansion revealed themselves through multiple interconnected channels that amplified the impact of monetary policy decisions. Banks received abundant reserves through Federal Reserve operations, which they then leveraged into loans at ratios that would have been considered reckless in previous decades. Mortgage lending standards relaxed dramatically as real estate speculation spread beyond traditional investors to include middle-class families who borrowed heavily against anticipated future appreciation. The stock market became a playground for margin buyers who could purchase securities with as little as 10% down, creating leverage ratios that magnified both potential gains and catastrophic losses. This system of excessive leverage was not an accidental byproduct of prosperity, but a deliberately engineered mechanism for concentrating control over productive assets while socializing the inevitable risks. The speculative bubble that emerged during this period built entirely on expectation rather than fundamental economic improvement, creating a disconnect between market valuations and actual productive capacity that would prove impossible to sustain. Corporate earnings grew modestly while stock prices soared exponentially, indicating that the market was pricing in future growth that existed only in the imagination of speculators intoxicated by easy credit. Real estate values in major cities doubled and tripled, based not on population growth or economic development, but on the availability of cheap financing and the assumption that prices would continue rising indefinitely. The agricultural sector, still recovering from post-war adjustments, saw land prices inflate far beyond what crop yields could justify, trapping farmers in debt obligations that would prove unpayable once the speculative fever broke. The consequences of this easy money policy created rapid enrichment for a narrow financial and investor elite, while establishing systemic vulnerabilities that would eventually destroy the savings and economic security of ordinary Americans. Those with access to credit markets and inside information accumulated vast portfolios of appreciated assets, while wage earners found themselves priced out of property ownership and pressured to enter speculative markets they did not understand. Debt-to-asset ratios throughout the economy reached dangerous levels as borrowers assumed that asset appreciation would continue indefinitely, making future debt service manageable through refinancing against ever higher collateral values. The banking system itself became increasingly fragile as loan portfolios concentrated in speculative real estate and stock market investments, creating interconnected risks that would amplify any future downturn. By 1928, the underlying fragility of this artificially constructed prosperity became masked only by the continuing surge in asset prices that validated the speculative assumptions underlying the entire structure. As prices soared beyond any rational connection to economic fundamentals and speculation deepened into pure mania, inflationary pressures began mounting throughout the system, while asset bubbles reached peaks that even contemporary observers recognized as unsustainable. The stage was set for the inevitable reversal that would transform speculative excess into deflationary collapse, revealing the true purpose behind the easy money policies that had created such dangerous systemic vulnerability. The speculative boom that had been carefully engineered through easy credit policies inevitably evolved into the second stage of the manipulation cycle, manifesting as rampant inflation that extended far beyond consumer goods to encompass the entire spectrum of asset classes throughout the American economy. This period between 1928 and 1930 represented not the natural consequence of economic growth, but the deliberate transformation of monetary excess into price distortions that would systematically redistribute wealth while creating the illusion of universal prosperity. The excess credit that had flooded the financial system during the previous 4 years now translated into rising demand for goods, commodities, and assets that bore no relationship to underlying productive capacity or real economic improvement, establishing the conditions for a wealth transfer mechanism of unprecedented scale and sophistication. The mechanics of this inflationary phase operated through interconnected channels that amplified the impact of speculative excess while disguising its ultimately destructive nature. Stock prices detached completely from corporate earnings as margin buyers bid up equity values using borrowed money, creating a self-reinforcing cycle where rising prices justified additional borrowing that drove prices even higher. Real estate markets experienced similar distortions as property values soared beyond any rational connection to rental income or replacement costs. Yet these inflated valuations served as collateral for additional loans that fueled further speculation. The wealth effect from these appreciated assets encouraged households and businesses to increase borrowing against their inflated holdings, generating artificial demand that pushed consumer prices higher while creating the dangerous illusion that debt burdens would become manageable through continued asset appreciation. This systematic disconnection between real productive growth and asset price inflation revealed the true purpose of the inflationary stage within the broader manipulation cycle. While stock market indices and real estate values reached unprecedented levels, actual industrial production and agricultural output showed only modest gains that could not justify the spectacular increases in asset prices. The speculative premium built into these inflated valuations represented nothing more than unbacked claims on future wealth that existed only in the collective imagination of leverage-intoxicated buyers. Corporate profits grew slowly, while stock prices doubled and tripled, indicating that the market was pricing in miraculous productivity gains that had no basis in economic reality. Agricultural land prices inflated far beyond what crop yields could support, trapping farmers in debt obligations based on speculative assumptions rather than farming fundamentals. The consequences of this artificial inflation created growing instability throughout the economic system while generating rising inequality between those positioned to benefit from asset appreciation and ordinary wage earners who found themselves increasingly priced out of property ownership and economic advancement. Asset holders accumulated paper wealth at unprecedented rates, while their debt obligations remained fixed in nominal terms, creating a powerful incentive to borrow against appreciated assets and invest in additional speculation. Meanwhile, workers and savers watched their purchasing power erode as consumer prices rose faster than wages, forcing them into speculative markets they did not understand or facing the prospect of permanent exclusion from asset ownership. Small businesses and households that had believed the boom would continue accumulated mounting debt burdens based on inflated collateral values, establishing the preconditions for devastating losses when the inevitable correction arrived. By 1930, the speculative excess had created asset bubbles so extreme that even contemporary observers recognized their unsustainable nature. Yet the wealth effect from continued price increases maintained the illusion that the boom could persist indefinitely. The mounting pressure from these distortions forced central bankers and financial authorities to confront the inflationary monster they had deliberately created, setting the stage for the deflationary countershock that would transform speculative mania into systematic collapse and reveal the true purpose behind the manipulation cycle that had been set in motion 6 years earlier. The third stage of the carefully orchestrated financial manipulation began in 1930, when monetary authorities, fully aware of the speculative excess they had deliberately fostered, moved to implement the classic deflationary countershock that would transform widespread leverage into systematic collapse. This monetary tightening represented neither a panicked response to unexpected inflation, nor a well-intentioned attempt to cool an overheated economy, but rather the calculated execution of the next phase in a wealth transfer mechanism that required the destruction of speculative positions held by ordinary citizens while preserving the core financial infrastructure controlled by elite banking interests. The Federal Reserve's decision to raise interest rates and impose bank liquidity constraints marked the beginning of a debt deflation cycle that would systematically eliminate the paper wealth accumulated by middle-class speculators, while concentrating real assets in the hands of those positioned to survive the coming collapse. The mechanics of this deliberate tightening operated with devastating precision against the leveraged positions that had been encouraged during the previous boom phase. Rising interest rates immediately made servicing the enormous debt burdens accumulated during the speculative mania prohibitively expensive for borrowers who had assumed that asset appreciation would continue indefinitely. Margin calls devastated heavily leveraged stock market participants who found themselves forced to sell appreciated securities at precisely the moment when credit contraction was driving prices lower, creating a self-reinforcing cycle of liquidation that accelerated the collapse. The same dynamic operated in real estate markets, where property owners who had borrowed against inflated valuations discovered that declining prices left them with debt obligations that exceeded the value of their collateral, triggering distressed sales that further depressed asset prices throughout the system. The contraction of credit availability spread systematically through interconnected financial networks, transforming individual failures into cascading collapses that revealed the inherent instability built into the boom phase lending practices. Banks that had extended loans based on speculative asset valuations found their portfolios deteriorating rapidly as borrowers defaulted and collateral values plummeted below outstanding debt balances. The resulting cash flow stress spread across leveraged borrowers and banking institutions alike, creating liquidity shortages that prevented the normal rollover of short-term financing that had sustained the speculative bubble. Corporate borrowers who had expanded operations based on inflated expectations found themselves unable to service debt loads while facing declining revenues, forcing widespread business contractions and layoffs that accelerated the deflationary spiral. The consequences of this engineered tightening manifested as wave after wave of bankruptcies among speculators, businesses dependent on easy credit, and the banking institutions that had enabled their leveraged positions. Asset fire sales became commonplace as distressed borrowers attempted to raise cash by liquidating holdings at any price, creating precipitous losses for anyone who had borrowed heavily against appreciated assets during the boom phase. The banking sector experienced increasing instability as loan losses mounted and depositor confidence began to erode, setting the stage for the systematic crisis that would justify unprecedented government intervention in the monetary system. The collapse of bank balance sheets, particularly among institutions that had extended the most aggressive credit during the boom, represented not mere bad luck or poor judgment, but the inevitable result of structural vulnerabilities that had been deliberately engineered into the system. Academic research across multiple countries and historical periods demonstrates conclusively that U-shaped monetary policy paths involving long expansion, followed by sharp tightening, substantially increase the risk of banking crises, yet this pattern continued to be implemented with predictable results. As credit availability dried up and defaults mounted throughout the economy, fear and contagion spread systematically across the banking system, transforming isolated institutional failures into threats that could bring down much larger financial entities and justify the comprehensive restructuring of monetary arrangements that would follow. The fourth stage of the systematic wealth transfer operation manifested between 1931 and early 1933, as the fragility deliberately engineered during the boom-bust sequence culminated in wholesale banking failures and the complete collapse of public confidence in financial institutions. This phase represented not the unfortunate consequence of economic miscalculation, but the predictable result of structural vulnerabilities that had been systematically constructed to concentrate wealth and power during moments of crisis. The banking collapse that emerged during this period served the dual purpose of eliminating competition among financial institutions while creating the justification for unprecedented government intervention that would fundamentally restructure the monetary system in favor of centralized control. The systematic destruction of smaller banks and the consolidation of surviving institutions under federal oversight represented the logical culmination of policies designed to transform a decentralized banking system into a centrally managed apparatus serving elite financial interests. The mechanics of this engineered collapse operated through interconnected channels of contagion that transformed isolated institutional failures into systematic threats to the entire financial architecture. Bank runs accelerated as depositors, witnessing the failure of neighbouring institutions, rushed to withdraw funds from banks that could no longer meet their obligations due to deteriorating loan portfolios and evaporating liquidity. The fractional reserve system that had enabled excessive lending during the boom phase now amplified the crisis as banks discovered they held insufficient reserves to satisfy withdrawal demands, forcing even solvent institutions to freeze operations or close their doors entirely. Interbank lending, which had provided crucial short-term liquidity during normal operations, seized up completely as financial institutions hoarded cash and refused to extend credit to counterparts whose solvency had become questionable. The resulting credit crunch prevented new lending throughout the economy, while existing debt burdens could not be rolled over, creating a deflationary spiral that destroyed businesses, eliminated employment, and devastated the real economy beyond the financial sector. Corporate borrowers found themselves unable to refinance maturing obligations while facing declining revenues from economic contraction, forcing widespread bankruptcies and layoffs that accelerated the deflationary pressure. Agricultural producers, already struggling with debt loads accumulated during the land speculation boom, faced complete collapse as commodity prices plummeted and credit for seasonal operations disappeared entirely. The unemployment rate soared as businesses eliminated workers to conserve cash, while deflation increased the real burden of debt obligations throughout the economy, creating a self-reinforcing cycle of contraction that appeared to threaten the entire economic system. The systematic panic that emerged from these conditions generated severe deflationary pressure that rendered ordinary citizens' savings either worthless or inaccessible, while creating the crisis atmosphere necessary for radical policy interventions. Depositors watched helplessly as bank closures eliminated access to their life savings, while those who had trusted the financial system discovered that their accumulated wealth had effectively vanished overnight. The collapse of confidence extended beyond banking to encompass fundamental distrust in money itself and the entire financial architecture that had governed economic relationships for generations. This manufactured crisis provided perfect cover for the Emergency Banking Act of March 9, 1933, which granted unprecedented powers to federal authorities to shut banks during a declared bank holiday, inspect their operations, and reopen only those institutions deemed suitable for continued operation under government oversight. The banking bailout that followed represented only a temporary stabilization measure that failed to address the deeper structural issue that would justify the final phase of the wealth transfer operation. The gold standard fundamentally limited the government's ability to expand the money supply, inject unlimited liquidity, or implement the massive fiscal programs that would be necessary to consolidate control over the monetary system. With banking stability in ruins and currency constraints preventing monetary expansion, the stage was set for the ultimate step in the systematic restructuring of American finance, the physical confiscation of gold, and the permanent elimination of private monetary alternatives that could challenge state control over currency and credit. The fifth and final stage of the systematic wealth transfer operation commenced on April 5, 1933, when President Franklin Roosevelt signed Executive Order 6102, which criminalized private possession of gold coin, bullion, and certificates beyond minimal exemptions, and forced American citizens to surrender their monetary gold to government authorities within 26 days. This executive action represented not desperate crisis management responding to economic emergency, but the carefully planned climax of a multi-year operation designed to strip private citizens of their most fundamental monetary asset, while transferring control of the entire monetary base to centralized state authority. The gold confiscation marked the moment when the systematic manipulation that had been orchestrated through the previous 4 stages achieved its ultimate objective: the elimination of private monetary alternatives and the establishment of a fiat currency system controlled entirely by government and central banking interests. The mechanics of this confiscation operated with ruthless efficiency to ensure maximum wealth transfer while minimizing resistance through legal intimidation and narrow compliance windows. Citizens were required to deliver most of their gold holdings to Federal Reserve banks or designated government agencies by May 1, 1933, with criminal penalties including fines up to $10,000 and imprisonment up to 10 years for those who failed to comply. Compensation was fixed at the artificially suppressed official price of $20.67 per troy ounce, a rate that had been maintained through government intervention despite growing pressure from international markets. The exemptions provided were deliberately narrow, allowing citizens to retain only approximately $100 worth of gold coins, certain collectible pieces, and gold used for legitimate industrial or jewelry purposes, effectively eliminating private gold ownership as a practical store of value for ordinary Americans. The Gold Reserve Act of January 1934 ratified this massive confiscation, while granting the federal government complete control over national gold reserves, formally severing the link between currency and private gold ownership that had provided monetary stability for over a century. This legislation authorized the immediate devaluation of the dollar to $35 per ounce of gold, generating an instant windfall of approximately 69% for the government on the gold it had seized from citizens at the previous official rate. The devaluation represented a direct transfer of wealth from private savers to government coffers, while simultaneously reducing the real value of dollar-denominated debts throughout the economy, providing artificial relief to borrowers at the expense of creditors and savers who had trusted the monetary system. The consequences of this monetary reset extended far beyond immediate wealth confiscation to encompass a fundamental restructuring of the relationship between citizens and money that would persist for generations. The government and treasury gained monopoly control over the monetary base, enabling rapid expansion of money supply unbacked by gold reserves, and facilitating massive fiscal programs that would have been impossible under the previous gold standard constraints. Private ownership of monetary gold remained illegal until 1974, meaning that an entire generation of Americans was systematically barred from holding the traditional hedge against currency debasement and inflation that gold had provided throughout human history. This 41-year prohibition eliminated competitive monetary alternatives while forcing citizens to hold their savings in assets controlled by the banking system and subject to systematic debasement through inflationary policies. The 1933 gold seizure represented the culmination of a comprehensive Great Reset that fundamentally redefined money, credit, and value relationships throughout American society. The old monetary order based on gold standard principles, private gold ownership, and decentralized monetary alternatives was permanently terminated and replaced by a fiat system controlled entirely by state and central banking authorities. This transformation concentrated unprecedented monetary power in government hands, while eliminating the financial independence that private gold ownership had provided to ordinary citizens, establishing the foundation for decades of systematic wealth extraction through inflation and monetary manipulation that continues to operate today. The historical pattern that culminated in the 1933 gold confiscation is now repeating with remarkable precision between 2020 and 2025. Demonstrating that the five-stage wealth transfer mechanism represents not ancient history, but a continuously operating system for concentrating financial control during periods of manufactured crisis. The same structural sequence that transformed American monetary arrangements 90 years ago has been systematically implemented through contemporary policy decisions that follow the identical progression from easy money expansion through asset bubble creation, inflationary surge, monetary tightening, and banking system stress that characterized the earlier manipulation cycle. The parallel development of these stages reveals that current economic disruption is neither accidental nor inevitable, but represents the calculated execution of a proven wealth transfer methodology that will culminate in the same type of asset confiscation that eliminated private monetary alternatives in the 1930s. The first stage manifested during and immediately after the COVID-19 pandemic, when central banks, particularly the Federal Reserve, flooded global markets with unprecedented liquidity through quantitative easing programs that dwarfed even the monetary expansion of the previous financial crisis. Fiscal stimulus packages, combined with near-zero interest rates to encourage massive borrowing and speculation across asset classes, generating explosive price increases in technology stocks, cryptocurrency markets, and residential real estate that created paper wealth for asset holders while establishing systemic leverage throughout the financial system. This deliberate expansion of money and credit followed the identical playbook implemented during 1924 through 1928, creating speculative bubbles built on cheap financing rather than fundamental economic improvement, while distributing risk to ordinary participants drawn into markets they did not fully understand. The second stage emerged as economies reopened and the excess liquidity generated during the pandemic response translated into sharp inflation that extended across consumer goods, commodities, and asset prices throughout 2021 and 2022. Consumer Price Index measurements rose from pandemic-era lows to multi-decade highs as the monetary expansion created artificial demand that exceeded productive capacity, while asset inflation continued driving property values and equity prices to levels that bore no relationship to underlying economic fundamentals. This inflationary surge replicated the dynamics of 1928 through 1930, where speculative excess disguised as prosperity created wealth effects that encouraged additional borrowing and risk-taking while setting the stage for systematic collapse. The third stage commenced during 2022, when the Federal Reserve embarked on one of the most aggressive monetary tightening cycles in modern history, raising the federal funds rate from near zero to over 5% within 18 months to combat the inflation it had deliberately created through previous policies. This sharp reversal from accommodative to restrictive monetary policy followed the classic pattern of engineered boom, followed by engineered bust, making debt service prohibitively expensive for leveraged borrowers while contracting credit availability throughout the financial system. The speed and magnitude of these rate increases created immediate stress for highly leveraged corporations, real estate investors, and financial institutions that had accumulated risk during the easy money phase, replicating the dynamics that triggered systematic failures during 1930 through 1932. The fourth stage is currently manifesting as mounting stress throughout the banking and financial sector, with regional banks facing deposit outflows, commercial real estate experiencing widespread distress, and heavily leveraged borrowers struggling to refinance maturing obligations in a high-rate environment. The same structural vulnerabilities that characterized the early 1930s are now evident across financial institutions that extended credit during the boom phase, while liquidity pressure builds throughout the system as borrowers face refinancing difficulties and asset values decline from their speculative peaks. Academic research demonstrates that U-shaped monetary policy paths substantially increase banking crisis probability. Yet this pattern continues to be implemented with predictable results that will justify comprehensive intervention. The final stage approaches as the systematic stress generated through the previous four phases creates the crisis conditions necessary for implementing asset confiscation and monetary reset targeting gold, silver, cryptocurrency, and other private stores of value that exist outside direct state control.